Hello and welcome to the Scan the Markets webinar with myself, David Madden. I work as a market analyst here in London and I work for Equity Capital, and Equity Capital is a part of the overall equity group, which of course includes FX Pesa in Kenya and also Equity Nigeria. Now, on this live webinar, I've run through six charts and covering some of the main macroeconomic instruments. I've written here most of my charts here have three or two bullet points covering some of the kind of fundamental and macroeconomic news, and I've also pointed out on the charts here some key price levels. So the first one we're going to look at is gold, and essentially, because of the war in Ukraine, we've seen high levels of volatility in gold. Gold hit its highest level since August 2020, at the beginning of the month, at the height of the Russian invasion of Ukraine. The height of the, sorry, I should state the height of the fear about the war drove up gold to a level last seen in late-ish 2020. But since then, some of the fear in the markets in relation to the war has evaporated. Now, sadly, the conflict is still ongoing. Traders seem to be more interested in the economic war between Western governments and Russia rather than the actual conflict on the ground in Ukraine. So we saw a sharp move to the upside, followed by a sharp move to the downside. Things appear to be settling again in gold. The last few days we have been moving higher. In fact, today we've actually hit its highest level in about 1 week. Also, another reason why gold is doing well is because gold has traditionally been a popular investment during high periods of inflation. It's often referred to as a hedge against inflation. And here in the UK, inflation as of yesterday hit a new 30-year high. In the last few days, we've seen US inflation a new 40-year high. Inflation's on the rise in the Eurozone, and inflation's on the rise around the world. So it seems that gold is benefiting from that old kind of hedge against inflation trade as well. Looking at the price action here, even though we endured a fairly sizable sell-off in the kind of early to mid-March, since then we have been seeing moves higher. As I mentioned a minute ago, we've hit its highest level in about a week or 10 days. We can see here on the MACD indicator that positive momentum is increasing. So that suggests that the bulls are not only in control, but they're also gaining control. If you continue to hold above these three simple moving averages, just to clarify, I'm looking at the this here is the 20-period moving average, the 50-period moving average, and the 100-period moving average. And I am looking at a 4-hour chart. If you continue to hold above these three moving averages, it's likely the recent upward trend will continue. Moving higher from here, we could target 1978, and a break beyond that, could see a target 2009. If you take a look at the RSI, we can see it's very close to overbought territory, which could be, and if we do move into overbought territory, that could be an early warning that the recent upward move in price has become overstretched. And if that were to be the case, that could be an early warning that we could see a change in trend. There's no guarantees that there will, but when markets move into overstretched territory or overbought territory, overstretched territory, it's not uncommon for them to retrace. Like what we saw here, the market was overbought in around the 7th, 8th of March, which coincided with this peak here, and then we saw a move to the downside. But you know, in trading, there are no hard and fast rules, there are no guarantees. But if it does move into overbought territory, that could be an early warning sign that a bit of a pullback or a sideways period of trading could be in the offing. So if we do see a move to the downside in gold from here, where can we find support? We can find support from the lows of last week in around 1895, and a large break below that could see us back down towards 1878. Coming on now to the next chart is euro dollar, a currency pair which has been also seen a lot of volatility on account of the war in Ukraine. Why is this? Well, some of the major economies of the Eurozone, most notably Germany, are very dependent on Russian gas imports. Something like 55% of German gas imports come from Russia. In Italy, it's around 45%. In the Netherlands, it's around 25%. So some of the largest economies in the Eurozone are very dependent on energy from Russia. So the fear is, what if Russia were to intentionally cut off supply as a way of heading back to the West? Or else, what if, from a logistical point of view, some of those pipelines that are supplying energy from Russia into Western economies of Central and Western Europe, what if they're impacted? So with this, there's a fear that the Eurozone, because it's geographically and through fuels tied in with Eastern Europe and also Russia, there's fears that the Eurozone is going to be dragged down by this. In turn, we saw a sharp move in the downside, then the downside in early March in euro dollar. Since then, we have seen a higher high, a higher low, a higher high, but we have been seen drifting lower again in the euro. Why is this? You know, even though some of the fear surrounding the war in Ukraine has evaporated, it's not as bad as it was a week ago or 10 days ago, it's still a lingering, ongoing concern. There's also issues in relation to how the Federal Reserve have already hiked interest rates this year. They've alluded to the possibility of several more interest rate hikes this year. In addition to that, in the next few months, if the Federal Reserve do carry out further interest rate hikes, we might even see interest rate hikes of 50 basis points, 0.5%. So it could be actually larger hikes than what we've usually seen. And essentially, the divergence between monetary policy, the European Central Bank weren't particularly close to hiking interest rates even before the war in Ukraine broke out, whereas the Federal Reserve are actually appear to be going on the path of several interest rate hikes this year. So the divergence in the policy of the European Central Bank and the European Central Bank, the divergence between the Federal Reserve and the European Central Bank seems to be kind of weighing on the euro once again. It's also worth pointing out the ongoing conflict in Ukraine. To a certain extent, not a massive extent, but to a certain extent, the US dollar is sort of acting as a safe haven play, a safe haven destination for funds, whereby traditionally, whenever there's uncertainty in the world and uncertainty in the financial markets, certain assets such as gold, typically and historically the Japanese yen, they've usually benefited because people tend to put their funds, take their funds out of riskier assets such as stocks and equities and put it into assets that are deemed to be low risk, such as gold and the Japanese yen, and to a certain extent, the US dollar. So the fact that we have the ongoing war in Ukraine, that seems to have put a bit of upward pressure on the US dollar and in turn downward pressure on the euro. So while the euro continues to hold below these three simple moving averages, it's likely the recent bearish trend will continue and move lower from here. Could see it retest the lows of mid-March in at one spot 08.99. And a break below that could see a target of one spot 08.05. If you do see a continuation though of this more medium-term upward trend in euro dollar, because let's face it, in the last few weeks we have seen a higher high, a higher low, a higher high. If this turns out to be just another higher low and the market rebounds higher and rallies from here, we could encounter resistance at last week's peak in at one spot 11.36, and a break above that could see a target this zone here at one spot 12.32. Coming on now to the S&P 500, the major stock market in the US. Now, one of the kind of factors that's been going, which is common around the world, not just in the S&P 500, is that stock markets around the world for the last week or 2 weeks have been rebounding. As I said in previous charts, some of the fears around the violence in Ukraine, although it's as tragic as it is, it hasn't been as brutal as the markets were initially concerned, because in the earlier days of the Russian invasion of Ukraine, people were worried about is Russia going to launch an attack on other countries in Eastern Europe. One of the headlines coming out of Russia in the early days was that allegedly the nuclear specialists were on high alert. So people were thinking, are we going to have nuclear devices used in this invasion? Also, it seems that Western governments, the likes of the UK and the US and some of the major economies of the European Union, it seems they're more interested in fighting an economic war with Russia in terms of sanctions, in terms of assets being frozen, and also the Russia being kicked out of the SWIFT payment scheme. It seems they're more interested in an economic war with Russia than they are with the military war. And with that, that's kind of left as bad as the situation is. It hasn't kind of inflamed Russia's view of the West. And with that, we've seen stock markets around the world, including the S&P 500, drive higher. In fact, in the last couple of days, we've seen the S&P 500 hit a 5-week high, which is really remarkable when you think a war is going on in Eastern Europe. We've already had one interest rate hike from the Federal Reserve. The Federal Reserve are looking at doing larger interest rate hikes in the months ahead. They're looking at possibly having several more interest rate hikes. And that all being said, these are all kind of, most economists would tell you on paper, this is the sort of thing which would lead to kind of stock markets going lower. we continue to see higher. So it really it really is a testament to how strong the S&P 500 is, that it can rally in the face of a war, in the face of rising interest rates, and in the face of potentially more rate hikes to come. Also, it's worth pointing out, though, we have seen an improvement in the US economy. The US jobless claims reading in the US, which essentially is a measure of all those people who are receiving unemployment benefits, fell to its lowest level since 1969. So think about this: 2 years ago, we had the pandemic, and the United States and other economies around the world were locking down and shutting up. What did we see in relation to that? We saw a collapse in economic activity for a few months. Then we had a major stimulus package. We had central banks cutting interest rates to almost zero and pumping money into the system. Governments did their bit as well. And now we're at the point where the number of people filing for unemployment benefit in the United States is back to its lowest level since the late 1960s. So for all these reasons, we're seeing a decent rally in the US 500. We have seen a bit of a hiccup or a decline and bounce back in the past 24 hours, but we can see here that we're holding above all three of these moving averages. In fact, as you can see here, the 20-period moving average on the 4-hour chart acted nicely as support. It acted nicely as support in this period here and here in this time frame as well. While the US 500 continues to hold above these three simple moving averages, it's like the recent upward trend will continue. A move higher from here could see it test this peak here, the highs of early-ish February in around 45.92, and a break beyond that could see a target 46.00. But in the last 24 hours, we have seen a bit of a sell-off, such as here. Although we've rebounded, we haven't actually pulled back all of the ground that was lost in that sell-off. If you take a look at the MACD indicator, we can see that momentum is in negative territory, which suggests that bears are in control. To be fair, negative territory is in decline, so it seems the bears are no longer as influential as they once were, but it's worth noting it's still in negative territory. If you do see a decline in the US 500 from here, support could be found from this low here at the middle of last week, in around 40, or towards the end of last week at 44.23, and a break below that could see us back down towards 43.76. Looking here now at the UK 100, the FTSE 100, we can see here that, as I mentioned on the last chart, stock markets around the world have, broadly speaking, been rising, some more than others for various different reasons. But the kind of common theme is that as dreadful as the war is in Ukraine, equity traders, stock traders are no longer as fearful as they once were. So this was essentially the height of the fear for the Russian invasion of Ukraine. This here was in the first week of March. This coincided with the point from an earlier chart, when gold hit its highest level since August 2020. When gold was at $2,060 per ounce, the UK 100, the FTSE 100 had fallen through the floor. So now that we've seen the pullback in gold coinciding, we've seen the move higher in the UK 100, because people are essentially, were 2 weeks ago cashing in gold and buying up assets that were considered to be relatively cheap, such as the FTSE 100. The market's been moving higher. In the last day or two, we've seen the FTSE 100 hit its highest level in 4 weeks, which really underlines how bullish the market is. Similar situation with the S&P 500. In the last week or two, we've seen an interest rate hike from the Bank of England. So they've had 3 hikes in only a few months, which once again, on paper, raising of interest rates typically in the near term puts a better pressure on stock markets. We can see here that the Bank of England have hiked rates only last week or two. With that hasn't stopped the UK 100 move higher and higher. Traders are less fearful about the war in Ukraine, as they are across the board. But one of the other reasons why the UK 100 for a European stock market has had such a strong rebound since the Russian invasion of Ukraine is because commodity stocks have performed quite well. The underlying oil market and the underlying metals market, copper, platinum, palladium, silver, they performed fairly well during the crisis, because Russia is when it comes to minerals, is a superpower. It's a major exporter of oil and gas. It's a major exporter of various different metals as well. And for that reason, traders are kind of fearful. What if supply lines get impacted because of the conflict? What if Western governments deliberately stop, or Western governments or companies deliberately stop purchasing minerals from Russia. Maybe not a full-scale embargo, but maybe an intentional way of getting back at the Moscow administration by deliberately not buying certain minerals from Russia. So metals have performed well, oil have performed well. In turn, mining companies and oil companies have performed well, and they make up a relatively large portion of the FTSE 100 index. So that's one of the reasons why we've had such a strong, relatively impressive rebound in the UK 100. While it continues to hold above these three simple moving averages, it's likely the recent uptrend will continue. Moving higher from here, we could target this peak here at 75.64, and a break beyond that could see a target this zone here at 76.32. Now, if you do look to move lower here, because keep in mind, momentum is in negative territory. If you do see any declines in the UK 100, where can you find support? Support might be found at this area here, 73.85, and a break below that could see us back down toward this zone here at 72.57. I mentioned about how Russia is a major exporter of oil, so we can see here huge amounts of volatility in US oil. This is WTI, West Texas Intermediate. In the kind of first week or so of March, at the height of the fear around the actual conflict, what I talked about when stock markets were plummeting and the likes of gold was rallying aggressively, we could see here that we saw a sharp rally in US oil. In fact, it hit a 14-year high in early March because of that. Then some of the fear around the war in Ukraine faded, so we saw a fairly large pullback, fairly large drop off in the price of oil. It is worth noting, though, that the lows that we saw here are on the 16th of March. We're still comfortably above the lows of mid to late February, the lows that were set in advance of the Russian invasion of Ukraine. So even though we had a sharp sell-off, we didn't actually even kind of break below the levels that were set in advance of Russia's invasion of Ukraine. And since then, we've seen a sharp move to the upside. So why is this? We've already had the likes of the UK and we've already had some countries, including the UK and the US included, essentially looking at our banning Russian oil purchases, or looking to phase out Russian oil purchases. We've also had the European Union, who are a major purchaser of Russian oil. They've come out and they said they're considering an embargo. There appears to be a certain level of division of will they, won't they, or if they do, what's actually the ban or partial ban going to look like. But nonetheless, the very fact that they've been talking about that has kind of led to supply fears. Hence why we're seeing a move higher recently. So we appear to be kind of undoing the declines that were set last week. So we've already seen a higher high, a higher low, a higher high, a higher low, a higher high, a higher low. And as you know, a series of higher highs and a series of higher lows is going to be the textbook definition of an upward trend. So if you continue to hold above all three of these simple moving averages, it's likely the bullish run will continue. Moving higher from here, we could have to target this zone here in around 119.06, and a break above that could see a target 1.2647. Now, if you take a look at the RSI, we can see it's been moving lower the last few hours which indicates the price bias is at the downside. If you take a look at the MACD indicator, we can see that momentum has swung from positive territory to ever so slightly being in negative territory, which suggests that the bears are now in control. If you do see a continuation of this near-term bearish move in US oil, support could be found from this zone here, 106.68, and a break below that could see us back down towards 102.47. And lastly, now coming on to GBPJPY, the British pound versus the Japanese yen, or sterling yen, as I prefer to in the markets. Now, I want to talk about this currency pair for a couple of reasons. In previous charts, I've been talking about how traders are less fearful about the war in Ukraine, and therefore they're willing to sell assets, or in some cases sell assets that are considered to be low risk, such as gold. So when we saw a sharp move lower here in gold in kind of, in between the 8th and say the 17th of March, that was due to the fact that people were taking on more risk and dumping lower risk assets such as gold. What we saw in that period as well was around that time frame, we also saw people essentially sell the Japanese yen. Now, if you're looking at a currency pair here, GBPJPY, when you trade this currency pair, it's always the first currency you buy or sell. So the rise we're seeing in this currency pair is partially down to weakness in Japanese yen. Why is the Japanese yen weakening? Well, because people are less fearful about the war in Ukraine, and they're happy to take cash in their lower risk assets, such as gold and Japanese yen, and in turn buy stock. So we talked about a minute ago how the FTSE 100 recently hit a 4-week high. The S&P 500 over the States at a 5-week high. That's signs that people are willing to take on risk. They're in a risk on mode. They're willing to buy riskier assets. And if you're buying riskier assets, they're probably possibly also selling low risk assets, such as the Japanese yen. What's also going on with the British pound? Well, we've seen a decent economic indicators out of the UK economy. We had strong services figures coming out of the US, so the UK economy rather, this morning. The flash services figures for the PMI report for the UK had a 9-month high, and the service sector in the UK accounts for around 75% of economic activity, or maybe even 80% of economic activity in the UK. So when the service sector is strong, the UK is strong. We saw inflation yesterday in the UK hit its highest level. A new 30-year high was set. We've already had an interest rate hike from the Bank of England only in the last week or two. So in many regards, the British pound itself is strong, combined with a weak Japanese yen, hence why we've seen such a sharp move to the upside in sterling yen. In fact, we've actually got multi-year highs on sterling yen. And the fact that we've hit multi-year highs really underlines how bullish the recent upward move has been. If we continue to hold above these 3 simple moving averages, it's likely the uptrend will continue. Moving higher from here on sterling yen, we could be looking to target 162.00. And a break above that could see a target 165.00. If we do see any moves to the downside in sterling yen, because let's face it, if you look at the RSI, we're in overbought territory. That could be an early warning sign that the recent downward move in price, so the recent upward move in price, has become more stretched. If you do see any moves lower, support could be found from this zone here around 159.02. And a drop below that could see us back down toward this zone here around 157.87. So this here, just to kind of wrap up the kind of major themes of this market, and the reason I wanted to touch on a few popular assets, like the stock markets some of the stock markets, such as the S&P 500 and the UK 100, but also the Japanese yen and gold, is because for those of you who are kind of new to the financial markets, it's important to get a feel for the big picture of what's going on. Not to say the stock markets always move in tandem with each other, or certain relationships always hold up. But broadly speaking, if you will see stock markets rising, it's possible that you might see assets that are considered to be lower risk, such as the Japanese yen falling, or such as gold falling. And then conversely, we have periods of whereby stock markets are falling and traders are fearful for whatever might be, war in Ukraine, higher inflation, higher interest rates, all of these sorts of things. This is the sort of time period you can actually see stock markets falling, but you can also see a rise in the Japanese yen or a rise in gold. So it's important to look at the markets across the board, even though you may not ever trade, in this case, sterling yen. The price action of sterling yen, the fact that it's at a multi-year high, tells you something. It tells you that something like partially the British economy is strong, but also the Japanese yen is weak. We're just coming up to half past the hour now. I am going to wrap things up there. I do appreciate you were logging in, and feel free to sign up to next week's event as well. Have a good evening, everyone. Thank you and good night.